Global debt has surged past $320 trillion and is nearly triple the value of everything the world produces in a year. Something extremely strange is happening, and you should be aware of it right now. Imagine a clockwork global economy where governments print a lot of money, borrow even more than they earn, and balance on the edge of catastrophe. This leaves citizens feeling squeezed and businesses uneasy. What's fueling this strange mix of growth and deep fragility at the same time? In this video, we are going to reveal the forces at play and why the world economy seems off lately. The moment you start taking note of prices at the checkout line, increasing interest rates, and social media posts from friends saying they're just scraping by, you realise something isn't right. What exactly has changed? First, let's take a look back at early 2020. Just when the pandemic became overwhelming, it froze economies worldwide, shut down factories, and grounded flights all over the world. This made most governments pour more cash into their respective stimulus plans. Then in early 2022, Russia's full-scale invasion of Ukraine sent the price of energy and the disruption of the supply chain through the roof. In other words, the already fragile systems became more buckled under the new confrontation. 3 years later, the ripple effect is still being felt across nations. For example, the interest rates across America and Europe now sit between 4% and 6%, making it the highest in over a decade. The rise is meant to control inflation, but is making borrowing more expensive. At the same time, most governments are carrying record levels of debt. The United States' national debt recently surpassed $36 trillion. Even across the Pacific, China carries more than $18 trillion in natural debt as of 2025. When you add up other leading economies like Japan, Canada, Germany, and Brazil, you get a global government borrowing index that adds up to a staggering $300 trillion plus in total. But here is where it gets even more interesting. The growth of these countries is still happening. Some of these countries are barely expanding, while others are steadily scaling forward. Yet beneath all of these, the scores of their system feel unstable. Take Europe for example. Inflation has dropped significantly among member states from 11% it was in October 22 to around 2.7% in February 2025. However, the growth of wages has yet to catch up, which leaves more families feeling the squeeze. In developing markets such as Turkey and Argentina, the pain is worse. Currencies are getting weaker even as inflation remains persistently high, sometimes above 20%. Some of these countries have reported a decline in their foreign reserves amid the sharp rise in unemployment. Meanwhile, central banks across Europe are in a bind. Do they raise the interest rates to control inflation, which will risk economic slowdowns or even recessions? Or do they ease up and risk runaway prices? Indeed, consumer confidence is getting soft across many developed countries. Surveys suggest 3/4 of people in major economies are expecting higher prices over the next couple of years. When citizens hesitate on their purchasing options, businesses often respond by delaying their expansion plans, which adds to the uncertainty. Here are economies that still work very well on paper with higher output ticks, and where jobs still exist but don't feel stable. You might be tempted to ask why. Well, one reason is the fragile structure beneath it all, and that brings us to a system that only a few people see clearly: global debt loops. If the world is alive with borrowing and lending at an unbelievable level, then who exactly is doing the lending in this tangled web, and what happens if the loop gets caught? At first glance, national debt seems simple. A country borrows money by issuing bonds, promises to pay back with interest, then later repays or rolls them over. But all over the world today, this system doesn't operate in such neat lines. Instead, it operates in a tight loop where everyone owes someone, often at the same time. Let's start with the United States. About 70% of US government debt is held within the country, often by American banks, pensions, and insurance funds. As of May 2025, US commercial banks reportedly held roughly $4.5 trillion in treasury bonds. Pension funds also put a quarter of their total assets into bonds during the same year, and most insurance companies also placed over 60% of theirs into them as well. So, the US government borrows from its own citizens' savings. Then, when these bonds mature, the government pays back its interest by returning the money to the very institutions that hold the debt. It's more or less a self-funded cycle. That seems reasonable, right? Well, that's until you look beyond domestic borders. In contrast, the rest of the US debt is held abroad, which is roughly 30%. Foreign central banks and governments such as China, Japan, the UK, France, and Germany hold huge shares of American treasuries. In 2024, China revealed it had about $759 billion in US debt, while neighbouring Japan held over $1 trillion. This means the United States' debt is financed partly by global investors who are seeking safe returns. But here's where things get even more interesting. China, in turn, has its own debt obligations. Chinese banks and the state borrow from each other, but they also hold debt from different nations, including United States treasuries. Similarly, Japan holds bonds not just from its own government, but also from other countries. European pension funds and central banks are known for investing in US and Japanese bonds. The same happens in Latin America and elsewhere. The result is that money and debt easily begin to grow in loops where one country lends to another, then gets paid back, or the debt gets rolled over. Every dollar spent by one government ends up in someone else's bond market, which then pays back interest to the original lender, and so on. Why does this matter? Well, this happens in most cases because such interdependence reduces risks. If one major borrower struggles to pay interest or roll over their debt, it can ripple through the loop. Investors begin to panic, interest rates start to rise, and the value of the currencies fall. Suddenly, the whole loop creaks. If a country agrees to cut off any single pathway, say its central bank decides to stop buying US bonds, that can spike borrowing costs across borders. Yet politicians are afraid to stop the flow, fearing immediate fallout such as recession, unemployment, and social unrest. That's why, despite mounting debt, most of the time the loop continues. And there's another hidden layer: the domestic institutions themselves. Pension funds, insurance firms, and hedge funds all rely on steady returns. In Europe, most central banks sit on large bond portfolios, which often form part of their quantitative easing policies. If these institutions reduce bond buying, rates will rise and governments will feel pressured to continue borrowing. This circular system means that stopping or changing course a little can send shockwaves through economies. That's why even troubled nations keep borrowing. It's the only way to keep the loop alive. However, if this loop supports global borrowing, what happens when governments rely on it simply to survive, and not just to build infrastructures, but to pay bills and stay running? That's where things get even stranger. By the middle of 2020, borrowing was no longer a tool used only for emergencies. Governments began to lean on debt to cover other routine expenses, pay public workers, and invest in everyday services. Take France as an example. In the second half of 2024, the French government borrowed about €68.9 billion to fund schools, hospitals, and welfare across the country. Even before that, France had frequently rolled over debt to cover its past deficits. This was essentially borrowing to keep current structures running. On paper, growth was recorded, but in reality, the country had become reliant on borrowed money just to stand still. Meanwhile, in the United States, budget deficits in fiscal year 2023 reached a staggering $1.7 trillion, accounting for more than 4% of GDP. A large part of that went toward maintaining existing programs such as Social Security, Medicare, and even defense contracts. The trouble with this was that without borrowing, the government would have had to raise taxes significantly or cut down essential services. Neither of them was politically viable. China followed a similar path too. China's government spending reportedly fueled around 90% of its annual budget back in 2023, with much of it funded by debt. The country's local governments borrowed heavily through bond sales and infrastructure bonds, and these funds were used to build roads, bridges, and airports. This model often created growth, but again, the existing debt levels required more borrowing to manage interest payments. This led to a crucial shift in the global economy where debt became the engine of progress and the fuel for survival. Instead of relying on tax revenues or profit from innovations, public spending began to rely heavily on borrowing. And when interest rates drop, it is easy for governments to issue more bonds, and so they did and still do. But this also changed the relationship between growth and borrowing. The debt to GDP ratios of developed countries steadily climbed over the last decade. By 2025, several major economies including Italy, Japan, and the Euro area average had ratios exceeding 120%. That's not just high, but dangerously high. The problem was that investors assumed that governments would always pay back, and as long as rates stayed low, the system held on. Yet, as we saw, rates were rising as the US Federal Reserve and EU central banks were raising rates in response to inflation. That made borrowing more expensive, and suddenly again, governments were borrowing not just to invest, but just to pay the interest on old debt. Another factor that contributed to this new habit was stimulus spending. Across the world, stimulus became normal during the pandemic. In 2020, the US alone spent $814 billion to help households go through the effects of COVID-19. Later, more European governments injected their economies with a combined €1 trillion in grants, loans, and other subsidies. Even after emergency use, those borrowed funds had to be repaid. So this meant more debt, more stimulus, and more borrowing. However, this loop wasn't going to be viable forever. yet it persisted because it seemed to work. But while this debt-fueled model seemed to hold together globally, signs are beginning to show that it's starting to crack, and sadly, not all countries will survive. What exactly are these cracks, and who will most likely go down first? Let's find out. While wealthy nations manage to hold things together, several other countries have already begun to buckle under the weight of debt pressure. What happens when one node in this interlinked debt economy fractures? The fallout could spread like wildfire. Let's take a look at Sri Lanka. In 2022, the country defaulted on its foreign debt for the first time in its modern history, being weighed down with financing its infrastructures, fuel subsidies, and public salaries. Sri Lanka couldn't roll over a $34.8 billion debt package any longer. In almost an instant, its currency collapsed by more than 80%, inflation surged past 50%, and basic imports literally vanished. Major banks shut their doors, and prices went through the roof amid civil unrest in pockets. Then came the abrupt resignation of the country's president due to public dissatisfaction that was caused by economic collapse. Another good example of when things could go bad is Argentina, which has perpetually been in a debt crisis. In 2023, the country failed to meet its repayment target on roughly $44 billion. The result? The value of the peso against the dollar crashed even further. Inflation rose 200% as citizens lost their trust in how the government was handling the situation. Argentina attempted to negotiate debt relief and eventually agreed to deal with the International Monetary Fund. But the price was painful because this meant budget cuts, wage caps, and public sector layoffs. In sub-Saharan Africa, Ghana also teetered on the brink of an economic crisis in recent years. With a debt-to-GDP ratio of 110% and central bank reserves dwindling, Ghana was struggling to service its foreign debt, which was largely dominated in dollars and euros. Its CD fell to record lows in 2024. In response, the IMF intervened with rescue funds, but imposed strict conditions of tax hikes, subsidy cuts, and austerity. These cases all share familiar traits. First, high debt servicing eats into the budgets. As much as 40% of Sri Lanka's revenue went into just paying interest after 2022. Second, currency pressure hits hard. When a country's debt is foreign dominated, its currency devaluation makes repayment more costly. Third, inflation spirals. The struggle to service debt often leads to printing more money, which fuels inflation further. And finally, social distress, such as a huge public backlash and political change soon follow. Even a country as stable as Turkey has faced its fair share of stress. In late 2023, the Turkish lira plunged under market pressure as foreign debt was building up, combined with high inflation at over 60%. In response, investors fled and the economy slowed down. That signals that even a debt mess can hit even large, diversified economies. These failing economies show how systemic the issue could be. When the cost of debt service rises, money that should support schools, hospitals and roads goes into it. Social safety nets collapse, and in some cases, political instability follows. And as the volatility spreads outward, most central banks are already scrambling for solutions. But are the tools needed to make quick recovery still sharp, or have they blurred out? That's where the next unsuspecting danger lies waiting. The Federal Reserve and the central banks of most countries once held the most powerful levers. This is because they are in charge of cutting interest rates to spur spending and printing money to stabilise markets, but in 2025, many stakeholders are discovering that those tools are no longer as effective or risk-free as before. Since 2021, a good number of central banks have faced a dilemma with inflation on the increase while debt levels also remain sky high. For example, the US Federal Reserve maintained its benchmark federal funds rate at 4.5% from early 2025. At the same time, the US debt went up to 120% of GDP. Simply put, borrowing is now a roulette. Low rates help growth but inflate debt. High rates control prices but worsen the debt burden. Meanwhile, quantitative easing, which is the practice of buying long-term bonds to inject money into the economy, is becoming a double-edged sword. In 2020 and 2021, banks in the United States, the United Kingdom, the EU, and Japan purchased around $10 trillion worth of bonds to stabilise their markets during the COVID pandemic. This kept interest rates low, made borrowing cheap, and helped reverse a downturn as gross world products rose by 5.8% the following year. Yet that very easing injected liquidity that exaggerated asset prices, fueled housing bubbles in Canada and Australia, and recorded equity valuations in the US. By 2023, most banks began reversing QE. Still, by late 2024, they faced another problem. They needed new borrowing to support post-pandemic recovery, yet they couldn't afford further rate hikes or new rounds of money printing without risking runaway inflation or debt distress. This left them in a trap where both printing money and raising rates carry equally severe side effects. What followed from then on had real consequences as consumer and business confidence flagged. In Europe, banks paused additional rate rises as euro area inflation gradually cooled from 6.2% in March 2024 to around 3.5% in early 2025. Yet the ECB acknowledged that over a third of Eurozone governments are now spending more on debt interest than on education or environmental programs. That shift alone pressures tighter fiscal budgets and threatens long-term growth. Central bankers are now openly worried about stagflation, where inflation stays high while growth stalls. This exact scenario plagued developed nations in the 1970s, when rates rose by 15% amid an oil price surge. At that time, there was only limited global trade. In today's complex global economy, a modern stagflation episode could send dangerous shockwaves that crash markets, unsettle employment, and take away the purchasing power of many economies. The era of easy policymaking seems to be ending as central banks now stand at a crossroads where any choice seems fraught. The erosion of trust has consequences, and when citizens doubt the monetary policy of their nation, inflated rates can spark panic in markets or among savers. Most heads of central banks now employ careful messaging to maintain credibility. This is because they are aware that markets and the media are watching closely. What happens if those policymakers fail, if their tools are gone and their cycle of debt breaks? The consequences unfold in the next chapter, where we imagine a world where these strange occurrences become the reality of the world's economy. What would it feel like when all these debts suddenly dry up? What happens when the endless cycle of borrowing stops? Not too fast, but just enough that interest can no longer be paid. First would be a sudden deleveraging, which is the process of paying down debt instead of borrowing more. Households and governments start saying no, and if that happens, GDP can shrink to record lows. Debt to GDP ratios may fall, but real incomes and output would take a hit. Japan faced half of this scenario between 1990 and 2000, which triggered the lost decade. What if more economies repeat that again, this time only worse? Next is mass default, where countries can't meet maturity payments on sovereign bonds. A situation like that, such as that of Sri Lanka in 2022 or Argentina in 2023, already shows what this path looks like. What if multiple nations default at the same time? Global bond markets could freeze and credit ratings would tank. Investment funds holding this debt would collapse, further pushing negative signals into banking and global liquidity. Another approach on the table is debt relief, which, in historical terms, means a debt jubilee. Under a debt jubilee, poorer nations may have portions of their foreign debt wiped out or restructured. This helps countries return to growth, but now, who pays the cost? Lenders would lose their principal, and possibly trigger financial crisis in their banking systems. Then there's currency reform, where abandoning national currencies in favour of supranational units or commodity-backed currencies could fast become a thing again. Latin America tried such lessons from regional clones in the 1980s. The modern equivalent could be a digital currency tied to real assets. It might break the inflation/debt trap, but implementing that on a global scale would be mixed with logistical and political complexity. Another new idea would be linking borrowing to climate or public metrics. Under these plans, countries that constantly meet their emission targets or social investment goals would get lower interest rates. This creates a positive feedback where lower debt costs reward public goods. The EU floated this idea sometime in late 2024. However, the challenge it faced then was that of fair metrics and global consensus. Through all this, there's really no perfect plan. No governments, central banks, or private financiers seem to have a clear blueprint. We might be stuck in a system that thrives on borrowing and expands when it continues, but breaks when it doesn't. So long as money printing and debt issuance remain acceptable, systems can limp on. But if lenders, central banks, or voters say no more, the music really could stop. The question is no longer if, but when. So now we've seen it laid bare, the global economy in 2025 isn't just facing another bad year. It is trapped in a system that was designed to keep going, even when the brakes don't work anymore. Debt isn't just a tool but a foundation, and that foundation is beginning to crack. Thank you for watching. Don't forget to like, subscribe, and hit the notification bell so you never miss an update. See you in the next video.